Right now, global governments and technology conglomerates are actively hunting for the same capital. The global pool of liquid capital is rapidly draining under the immense weight of two deeply competing, simultaneous pressures. This chart highlights the divide. Sovereign governments require $18 trillion to fund their deficits. Meanwhile, the artificial intelligence sector demands a $2.5 trillion capital expenditure cycle. Sovereigns and tech giants now compete directly for the same limited pool of institutional savings. For a decade, zero interest rate policies provided enough capital to satisfy everyone. That environment has ended. Understanding how to secure funding in this squeezed environment is the strict mathematical prerequisite for balance sheet survival over the next 24 months. The sustainability of any national debt relies on a simple formula: the difference between real interest rates and real economic growth. Throughout the 2010s, interest rates stayed lower than economic growth. Governments could run primary deficits year after year without their debt-to-GDP ratios spiraling. In 2026, that math has definitively inverted. Real interest rates now exceed real economic growth. We see the sharpest impact of this inversion across the advanced economies of the OECD. Because of this specific mathematical flip, sovereign debt trajectories now slope upward by default, even if underlying economic conditions remain stable. By the end of 2026, total global borrowing by governments and corporations will reach $29 trillion. This data table breaks down the OECD aggregate indicators, showing gross sovereign borrowing hitting $18 trillion. $14 trillion is required immediately to meet 2026 refinancing obligations. This means 80% of all gross borrowing serves existing debt rollover, leaving little room for growth-oriented investment. The rising cost of servicing this old debt is adding 2.5 percentage points to the aggregate debt-to-GDP ratio. That absolute cost outpaces the 2.4 percentage point reduction generated by current inflation. The debt burden is now growing simply to pay for itself, forcing the OECD aggregate debt ratio toward 85%. The United States is the primary engine distorting this global fiscal landscape. Despite an expanding domestic economy, the U.S. Treasury continues to run pro-cyclical deficits approaching 6% of GDP. Recent legislative packages, combined with aggressive broad-based tariff implementations, have further skewed the baseline equilibrium. The tariffs operate as simultaneous negative supply and demand shocks. They induce domestic inflation while forcing costly reconfigurations of global production networks. This graph maps the U.S. yield curve, showing how the market prices this immense fiscal supply. The short end anchors in place, while the long end steadily elevates. This gap represents the term premium. Investors are demanding significantly higher yields to hold long-duration debt. Because U.S. Treasuries are the risk-free benchmark, clearing this massive supply requires higher yields, which absorb liquidity that would have gone to emerging markets or corporate bonds. The U.S. deficit effectively operates as a gravitational sink, dragging global interest rates upward and starving alternative assets of capital. Compounding this sovereign debt load is the simultaneous explosion of capital requirements for artificial intelligence. This is an industrialized physical infrastructure supercycle. It demands hyperscale data centers, specialized silicon, and dedicated power generation facilities. This chart details the worldwide enterprise spending forecast on AI. By the end of 2026, total required capital scales past $2.5 trillion. $1.36 trillion of this total is allocated strictly to raw physical infrastructure. To pay for this construction, highly profitable technology conglomerates are pivoting toward external debt markets. These tech companies possess AA credit ratings and offer attractive yields. They are now directly competing with sovereign treasuries for institutional savings. With both sovereign treasuries and tech conglomerates flooding the market with debt, the question becomes, who is actually left to buy it? For a decade, central banks were buyers of last resort. Now, the Bank of Japan is actively raising rates, threatening to pull domestic capital away. Into this systemic void step non-bank financial institutions and domestic commercial banks, both of which are highly sensitive to sudden price changes. This network graph illustrates a systemic fragility identified by the IMF, the sovereign bank nexus. Domestic banks are absorbing excess government debt, tying Tier 1 capital to sovereign bond yields. If yields spike, banks take immediate mark-to-market losses, severing lending to the private sector. This credit freeze halts the capital business's need for operations, creating a systemic risk that threatens the stability of both advanced and emerging economies. Navigating this environment requires corporate treasurers and institutional allocators to execute immediate defensive strategies. A massive wave of corporate debt maturity is now rapidly approaching, locking companies into a strict refinancing timeline. In the U.S. market alone, $930 billion of corporate debt matures in 2026. Another $860 billion follows in 2027. Predictive models indicate that 85% of this debt will have to be refinanced at interest rates significantly higher than the original issuance. To survive, institutional allocators must systematically manage duration risk. This means pivoting to ultra-short and intermediate-term maturities to hide from the expanding term premium at the long end of the curve. Simultaneously, corporate treasurers must deploy interest rate swaps today, locking in predictable debt servicing costs. Delaying these actions guarantees a direct collision with the AI hyperscalers at the refinancing wall, triggering severe corporate liquidity crises. Investors must also look outside crowded G7 public debt markets to find yield, starting with the structural divergence in emerging markets. The monolithic label of emerging market risk is outdated. Core emerging markets, like Brazil and Mexico, have proactively developed deep, liquid domestic capital markets. These core nations now fund up to 96% of their commercial debt in their own local currency. They absorb macroeconomic shocks effectively and offer robust yields that are mispriced by traditional risk models. For chief financial officers tasked with capitalizing massive infrastructure, the strategy requires exploiting alternative capital formation. Forward-thinking enterprises are now bypassing congested traditional banking systems and successfully accessing borderless, decentralized digital networks for capital. Architectures like decentralized physical infrastructure networks and real-world asset tokenization are increasingly being used to fund data centers and regional energy grids. Utilizing blockchain-based capital formation allows enterprises to route around traditional high-yield debt markets and directly tap into global liquidity pools. The era of hyper-optimized low-cost capital has ended. The mathematical inversion of interest rates and growth rates, combined with the intense competition for global savings, represents the new binding constraints of global finance. The only true shield against this volatility is robust financial reserves, a strategy executed effectively by nations like Singapore, which rely on the compounded returns of massive wealth funds rather than sovereign borrowing. Deferring action and hoping central banks revert to quantitative easing invites rapid, punitive repricing from bond markets. The 2026 paradigm makes robust fiscal buffers and proactive liability management the non-negotiable prerequisites for survival.